It is Siegel versus Schiller. New research from Goldman Sachs pits these two economists in a head-to-head. Both asked if U.S. stocks are overvalued. Yale's Robert Shiller says concern has risen and a correction could be coming in the next year, while Wharton's Jeremy Siegel takes the opposite view. Professor Siegel joins us now. Professor Siegel, what is your thesis?
Well, my thesis is basically that although, yes, I agree that the current valuation of the market, measured by the standard price-earnings ratio, is a little bit higher than the historical average. I think a higher P/E ratio is fully justified in a world of record low interest rates, and even when the Fed raises them, they are going to still remain low on a historical standard. And in my estimation and my colleagues at Wharton, a lower discount rate means a higher average valuation for the stock market. So I certainly do not believe that it is overvalued at current levels.
Professor Siegel, that's a key point. Where do you think Fed funds are going to peak once the Federal Reserve is at the apex of the tightening cycle?
Well, my belief is, and here one of the rare times when I agree with Bill Gross, as you know, we've disagreed a lot about the stock market over the last 5-6 years, but he named the new neutral of the Fed funds rate as 2%, and my own calculations confirm that the average Fed funds rate probably over the next decade is going to remain at 2. Now, that doesn't mean that at the peak of a tightening cycle it won't be above 2. It might get to 3 or maybe 4, but then it's going to be brought down below 2, back down to 1 or a half when the economy does soften. So we're going to have a lower average level of interest rates. Certainly the Fed funds rate might peak above 2, but I don't think it's going to be the 4% that we know the Fed has in its dot plot that it puts out every quarter in its economic projections.
In terms of valuations, though, is there a number, a range that does get you concerned?
Well, my feeling is that if we get well beyond 20, 22, 23, we're definitely now at a rich valuation. In perspective, the stock market got to 30 price-earnings ratio in 2000, and that was a period of much, much higher interest rates. So that was a clear overvaluation of the market. Even I was bearish in 2000. Those levels were not justified. But I can certainly see 18 to 20 as the new normal valuation in the market rather than 15, 16, which has been the valuation during most of the post-war period.
Professor, Goldman Sachs, as part of the research it did, quoting you, went back over the past 17 years and looked at a number of different kinds of assets and came to the conclusion that on a percentile basis, yes, stocks do look overvalued, but other things look even more overvalued, like 10-year treasuries, for example, mortgage spreads, volatility, and mortgage basis. Would you agree with that?
Well, the question is on bonds, and yes, interest rates are going to rise. We have the 10-year now a little bit above 2. I certainly think it can go to 3, 3.5, and probably that's the new normal 10-year. And that corresponds, by the way, to about 1.5 points above the Fed funds, and that's pretty much been a historical term spread there. So yes, bonds are much more expensive than stocks, but my feeling is, my calculations say that if the 10-year gets to 3.5, and that will impose some losses, certainly, on the bondholders, stocks at that level should be valued 18 to 20 at a 3.5% 10-year Treasury rate. So, yes, I would say bonds are more overvalued than stocks. I don't think stocks are overvalued. I think stocks are fairly valued given the new reality of lower growth and slower inflation that I think the U.S. economy is going to experience the next 10 years.
Professor Siegel, thank you so much for joining us.